Okay, quick word about the many benefits of becoming a member of the Green Star Trading Patreon. If you join our most popular tier, which is tier 2, you will get access to the public Discord with multiple channels covering dozens of subjects. You can ask me anything you like on there. There's a dedicated channel for that. You can make chart requests. You can even ask to have certain assets covered in the weekly live streams, and the weekly live streams are one of the benefits. These go on for several hours, between 3 and 5 hours, normally hosted on a Friday, but I always timestamp them so you can come back and watch them at any time you like at your leisure. You also get access to all of my educational content, including the Elliott series, trading series, technical analysis series. So there's an awful lot of value here for just £10 a month. It's an absolute bargain, to be honest with you. And then if you want a little bit more than that, you can pay £15 a month. You get everything I just previously mentioned, but you also get the exclusive monthly dividend calendar and stock rating system, and the video which comes along to support that, which we recently just got posted up for our tier 3s here. As you can see, top dividend stock picks for the month January 2023, 32 stocks listed, 16 ex-dividends for the month, with the calendar and stock rating system posted here as PDFs below. We can see a recent live stream, then we can see our economic indicators monthly review, where we went over housing, permit starts, completions, Institute of Supply Management report on manufacturing, report on business, manufacturing, consumer surveys, yield curve, blah blah blah. So there's a lot of extra content I pump out for the Patreon. It's not just educational videos, which you can now access the 16 video long Elliott Wave series, but it's also monthly data that I release only to my patrons, and it's also extra support for tier 3s as well. So please consider joining. It really is excellent value. Thank you very much for listening. Now let's get back to the video. Hello everybody, and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right then, today we're going to be having a quick look at Cardano, that's ADA USD. I was updating a bunch of charts last night for my Elliott Wave counts for my altcoins, and Cardano was one of the ones which drew my attention. And since then, over the last few hours, we've had a pretty significant rally. So a lot of people are going to be asking the question, is the bottom in? It's possible. I'm going to talk about what I want to see in order to gain conviction in that being the case, but I wanted to start here on the linear chart and just remind everybody, because I'm sure you know if you've been here, I've been in the crypto space since 2015. I've been through several cycles in the market. I know what they feel like now, I know what they look like, and this is very much what they look like on a linear scale. It's essentially a bubble. A bubble does not mean it cannot be reinflated, does not mean it's part of a longer bullish trend. It is simply market behavior. Amazon was a bubble during the tech bubble in 2000, and yet look at it today. So we mustn't take that as a derogatory term. We're not saying bubble as in it's gone and it's never coming back. We're talking about the psychological behavior of a market cycle compressed into such a short period of time. That's a bubble, and that's what we see here very clearly. So we go all the way up to the heights of euphoria, where everyone's a genius and this thing's going on forever, it's never going to stop, it's going to 1,000,000, and then we come all the way down into the depths of depression, where everyone is stupid. And that's essentially what we've done. Now, a market can only reach its peak in that euphoria, in this bubble, in this kind of market behavior, and a market can only reach its bottom, a market bubble like this, in those depths of depression and despair and giving up and hatred and mirth and vitriol and everything else which gets poured forth by the community which once loved it now hate it. And that is very much the psychology of a market cycle here, a bubble, and that's exactly what we've gone through. So I would argue we're in the correct psychological state for the market to bottom. That's not proof that it has by any means. It is simply anecdotal evidence which would help support any technical evidence which is forthcoming over the next few weeks and months. We should keep that in our mind before we start getting carried away with a few percentage of a rally when we've fallen 95%, just to get some perspective. That's what I'm saying. Now, I've started in the linear chart so that when I move into the log chart I can share something with you before I show you my longer term count, which I find very compelling here in Cardano, because this chart gives an example of an impulse wave which is clearer, has better relationships, more typical behavior of an impulse wave, and a beautiful, clear, wave-free extension than I have seen in many other cryptos. In fact, I would argue from the March low at least of 2020 that the impulse up to the high here in Cardano is probably the clearest example of an impulse wave in the sector. There may be others, but I haven't looked at all how many thousands there are. Okay, of the ones I've looked at, I would argue it's prettier than Bitcoin's. So let's get into it and tell you what I'm talking about. Alright then, so Elliott wave. First and the most basic wave in Elliott wave is the impulse. Okay, the way a market moves, directionality, or what is commonly known as trend. And that's what we've got here. 1, 2, 3, 4, 5. The 3 is longer than the 1 significantly, the 5 is shorter than the 3. Okay, the 4 does not overlap the 1. And what we see here within it is a really nice example of the subdivision which occurs within a wave 3. Okay, essentially what I mean by that is we get a bunch of overlapping waves here and a bunch of overlapping waves here. These are 1s and 2s, these are 3s and 4s, and we get a nice long violent move in the middle. That's very typical of the wave 3 extension. It's the most common extension within the impulse wave, and it occurs here. The next thing I would point out is if we take the 2 to the 4 for the final placement of the Elliott wave channel from the 3, we can see that we get the very typical underthrow of the first 1 and 2 within the extension coming out of the channel. This is very typical of an extension. We get a little bit of over exuberance within the 3 of the 3 overthrowing the channel. This is very typical. We come straight to the edge with the 3 itself, and we finish the median line with the 5. We can take a 1 to 3 placement and we can get the same over exuberance in the 3s, tops of the 3s, as we do with the bottoms here placing the 2 to the 4. So it doesn't really matter how you place a channel, it fits. That's my point, and it fits nicely. So a nice strong example of an impulse to the high. So what does that mean, Tom? Well, we all know, don't we? We're Elliottians. If you're not an Elliottian, this is the first time you've ever watched a video about Elliott Wave, I encourage you to head over to the Patreon. You can find the link in the description box below. Sign up and watch my 16 episode long Elliott Wave series, and you can learn all about it. It costs you a tenner to sign up for a month, so consider it. But either way, we get 5 and then we get 3. Now the 3 can take the form of zigzag, a single zigzag. It can take the form of multiple zigzags, a double or a triple. I think we've probably got something like that here. It can take the form of a flat, it can take the form of a sideways combination, and yada yada yada. Okay, and depending on where you are in the larger motive structure, it could even take the form of a triangle in the wave 4 or in the wave B of an ABC. Either way, we have 5, and 5 is followed by 3. Okay, corrective price action. We can see the difference. Alright, what an impulsive structure looks like. And then this, although it has, in this case, because it does appear to be without a doubt what we call a sharp correction, it however does not have that nice clear impulsive move. It's all higgledy-piggledy, and it's much more overlapping price data, and it's much more gradually sloped than this thing is here. So this is 5, this is 3, which means it will be followed by 5 again. Okay, and in a corrective form we would call that A, B and C. Okay, and in a larger impulse we would call that 1 and 2 and 3, and then there will be 4, and then there will be 5. Okay, and that's what we can look forward to. And because of the strength and the clarity of this 5-wave move, this clear impulse off of the March low to the high, I would back this one above many as actually doing that. Now there are many cases I've seen where we have a corrective move of some sort to the high, suggesting that cryptos which display that behaviour are likely not going to participate in the next bullish leg. Many will go to 0, some already have gone to 0. So it's a case of where we see a lovely clear impulse wave, obvious corrective behaviour, we should be highly confident in another move higher, and that's exactly what I am. Confident in another move higher does not mean I'm confident that we've bottomed. There's a big difference. Patience will be rewarded in this circumstance. Now I could be wrong, but given the evidence I've seen here on the chart, it looks perfectly believable that when this thing does, if it has already, or if it hasn't, when it does bottom, we will make new highs and go considerably higher. So let's have a quick look at some classical analysis before we move in and have a look at the Elliott wave count. So first things I want to look at is the time of these corrections, these prior corrections. So from the 2018 high to the March 20 low, we got 798 days. Okay, and from the August high through to what we're assuming might be the low, which was December 27th. I make it maybe, this is the day chart, I may not be over it perfectly, 483 days, so this is shorter. We don't have price data going back before this here, but if we did, I'd argue that this is most likely a 3-wave correction. Okay, as any attempt to make it a 5-wave correction does not fit very well. It does not channel very well, it does not subdivide very well. But 3 waves, it most certainly does. So that was a corrective move from this high. So we have gone some kind of swing, which was a very large and time-consuming correction. This one is significantly smaller, and therefore this is likely a smaller wave degree. Another 1 and another 2 of a smaller wave degree going much higher. Now this is not going to be an unusual count to anyone who's followed my videos. A younger asset doesn't have the same price history, we can't look back as far, but if we are part of a larger trend of the cryptos that will survive and advance into the future rather than the ones that won't, it would make perfect sense that this is a impulse and we are going to go higher. If we look at the corrections in price, we've got a 92.44% correction. This was 98.77. This is smaller than this in both time and currently smaller than it in price decline as well, suggesting that it is indeed a smaller wave degree. Now, it is extreme still. It is very severe at 92% decline, which suggests that it is indeed a wave 2, not a B wave. B waves are less likely to be that severe, so we're not looking at A, B, C in a 3-wave move to roll over and go lower eventually after going higher. We're looking at the more likely scenario of a 1 into a 2, as it is such a deep correction. Wave 2s have a very deep, on a larger wave degree, have a very deep retracement normally, and are normally filled with despair and anger, frustration, and all of the negative emotions within the market cycle. I recently did an updated video on the personality of corrections and the personality of motive waves as part of my Elliott wave series. You know, something I would very much recommend you sign up to if you're not used to Elliott wave and come over and learn. It's now a 16 video part series, so very informative. But either way, I digress again. Stop shilling, Tom. But well, you're shilling yourself, so I guess it's shameless self-promotion, let's call it that. Either way, most likely a wave 2. Fifth retracement. We've come roughly to the 50% retracement in log. We haven't made it to it exactly, but we've come into the neighbourhood of it. We haven't come through to the golden zone yet, and if this downward trend continues, we could. Okay, if we haven't finished going down. We are obviously a long way beyond the 89% retracement in linear scale because we've fallen that 90-odd%. Okay, so it's a very severe retracement. Already discussed that. Now let's have a look at some support and resistance. So, just using a fixed range volume profile of this last move up to try and shrink, or to try and make these small levels of volume, areas of volume here, a little easier to observe than if we use a larger fixed range volume profile. As you can see, that would represent the visible range volume profile we have on the right, where these little bumps are much greatly reduced. But if we isolate this last move up, we can get an idea of what was in that prior move up. And as you can see, we've come essentially to a price support level. It's not the strongest. This high here, these lows, these highs as resistance. Projected forward in time to these lows reaches here at 0.238. Okay, not the strongest support level, but it is a horizontal support level. Now the next strongest one we've got a high here, highs here, lows here, highs here, and a bunch of highs here at 0.194, and then we've got even stronger ones below that, and below that even. Okay, that we might come down to. No point putting them on the chart yet, as we haven't broken these local ones, but we have come back to support, and we have come back into the territory of a 50% retracement in logarithmic terms. Okay, set to log scale. If we look at that as well from a demand point of view, this little area of demand here, where we've got one or two overlapping waves where we've moved up, moved back, found buyers, moved up, moved back, found buyers, and advanced. We can see with our little fixed range volume profile that we had earlier. Okay, this covers from a low to the high. This one, this is a little area of demand. It's not massive, okay, but it is still a little area of demand, and we just managed to find a low inside of it. We've got a much bigger area below us here, right, and a little gap between us, and this leads us into the 61.8% retracement into that golden ratio. So if we were to come lower, we'd be coming down into this zone here where there's all this demand, all this volume. Much stronger place to actually bottom. I'm not saying we have to do that. We may have bottomed here, but if we do come down lower, wouldn't be surprised if we did that. Alright. From a volume perspective, we have had volume, some push from support for this recent rally. But as you can see on the longer term, we have very little volume at all. Very little interest out there. More a case of shorts capitulating and getting out than it is a case of bulls really piling in. But the move off of the low does appear impulsive, and it is day after day supported by greater volume. So it is a push from volume. And in that sense, we can have more confidence in this being an impulse wave, and therefore being bullish. Okay, so that's a positive sign, but overall volume is pathetic relative to where it's been in the past when we've been down towards this pricing in the past. You know, if we come back to this price over here, 26 bucks, 26 cents, 26 bucks, what am I talking about? 26 cents, we can see how much more impressive the volume was during that period than it is now. Okay, but that won't return until we get into the wave 3 of the next move up, and by then we will be so much higher that volume will not get back to these levels anyway. So it's just something to bear in mind, but it is still pretty lackluster at the moment, would be my point. Alright then, so from there, let's talk about the behaviour of this correction. The most obvious thing we've got here is this resistance, this downward bearish trend. So we want to see this broken. Right. We want to see a move from a bottom supported by volume, which this one is, and we want to see it break this trend. Okay, we then want to see it correct on a larger time frame. It doesn't have to come back to that trend, find support, and then move higher. Right. Now, obviously, if you're using the standard trade setup, the STS, which I teach on the Patreon, you can apply this to any time frame. You may already be in long after the first couple of pullbacks and enjoying this rally now, but on the larger time frame, we have more confidence when we see something like this, and then a smaller wave degree within that. So what we're looking for is essentially the larger wave 1 of the next wave up to complete. Right, that will give us more confidence, and a break of trend would definitely go a long way to helping convince us. The next thing we'd want to see, obviously, is we have a linear, we have a channel coming down here. Same gig, it's basically that downward sloping trend that we need to break. We've also got a little pitchfork here which contains it quite well, and accounts for that extreme reading on the extreme outer bound here. Broke the channel. A lot of movement around the extreme the outer bound here. A lot of play with the median line, as you can see, and a lot of play recently between the two 38.2s. So 38.2s here and 50, 38.2, 38.2 double bottom again. Yeah, basically moving inside of a channel inside of a channel. Now we've popped back up to the 60 and we've broken that. We haven't done that for a while, but we haven't done it at any time during this downward trend, so that's quite a positive little sign as well. The next thing I'd want to point to on the daily time frame, at least if we remove that, is the EMAs. So the cross below the 250, the 250 has acted as resistance once we've come up to meet it. The 60 has acted as resistance to all the smaller corrections, okay, which have occurred in this move down. We have broken it occasionally when we've consolidated for a bit longer, like here and like here, but we're back through it. So we're back through it now for the first time in some time, and it's a pretty significant move through it as well. So that's a positive sign that this little rally, if it does become a larger rally, started off nice and strong. Started off nice and confident, nice and positive. Yeah, but it's not proof of a bottom yet, but it's just a little bit of evidence in support of there being one. The next thing I would like to point to as well, and I'm going to start using this a little bit more often. I don't rely on it too heavily. Some people swear by it. I've been exposed to it for years and years of trading, but I tend to neglect it. And that is the use of fib time zone. Now, for me, this is not something, in my experience, that scales across all wave degrees. Sometimes it's relevant and fits nicely, other times it's a million miles off. So I don't tend to rely on it. But in this circumstance, we're taking the length of our impulse wave here to the high, and then we're looking at the extensions from there as to where we will likely find our second wave or the completion of our correction. This too, the green one here, represents the same length in time as this move up. So if we were to measure them, that's where the 2 represents here. It's not double the length as sometimes people mistakenly say. Yeah, for example, let's just take it and measure it. Move it across and you can see that it's exactly where the 2 would be. So here's our first move up and here's the correction we're looking to measure. Here's the 1618. After this point, where we've gone to 61.8%, the length of the prime move up, from this point onwards is where I would, in my mind, think that a wave 2 or a corrective move may have completed. At the actual length of the prior impulse is probably more likely, but anywhere in this area, pretty vague, all the way to 2.618. So 161.8%, the length of the impulse, we could see it bottoming, and in some cases even longer. But keeping in mind the kind of corrections we're talking about a sharp correction. There are sharps and there are sideways. Sharp corrections tend to do a lot more damage in price and a lot less damage in time, whereas sideways corrections tend to be more, well, less harmful in price and much more time wasting. This is a sharp, so bottoming somewhere between the 1618 and the 2 would be perfectly normal. To basically come down and complete a correction within the same amount of time or less than it took to get to the high, because we're talking about that sharp correction, and we're in that zone roughly now. Okay, so there you go. We've got our trend that we want to see broken, we've got our geometry that we want to see broken, we've come back to some degree of demand, we've come back to some degree of support, we've come back to a 50% retracement in log roughly. It's a okay place to bottom. It's by no means ideal, but maybe we won't get the ideal. Okay, so now indicators before we move on to look at the Elliott wave analysis, and let's just see what we can see here with our RSI, our MACD and our OBV. So one of the things which does stick out quite considerably regarding this recent rally, or what could be a rally, we don't know yet, is just how powerful the thrust back into overbought conditions was on the RSI. So during a bullish phase, the RSI behavior displayed of an impulse moving to the high or to the low, but what we tend to do is we tend to get a series of readings above the red bound here, which means overbought conditions, okay, frequently being visited. Overbought, back to neutral, overbought, back to neutral, overbought, back to neutral, larger wave degree correction, oversold, overbought, neutral, overbought, neutral, overbought, neutral, overbought, neutral, larger wave degree correction, oversold, completion, oversold, and then we go into a bearish phase, right? And in the bearish phase, the opposite is true. We get very few readings, very few overbought readings, but we get a series of oversold readings time and time again. You know, we might swing back and forth a bit more violently volatility and the rallies within a bear market can be pretty extreme, but they will not reach the extremes traditionally or or as often as they will in a bullish sequence. So what we've got now are a series of oversold conditions. You see how rare they were? They only appeared in the larger wave degree corrections. Now they appear frequently. Oversold, 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 oversold recently. Now we've done something that we haven't done since the high. We've broken out to a level in the RSI, overbought level, that we haven't reached since the high. If we are going to end this bearish trend, then getting back into a series of trending RSI moves which take us up above back into overbought conditions frequently, and then only revisit oversold with larger corrections again, then we are on our way up. So that is another little piece of evidence that the aggressiveness of that thrust, that is another little bit of evidence that we may well have bottomed. Okay, now with the MACD, we've been building up a long-term bullish divergence in momentum because the selling off have just gotten so extreme. So a series of higher lows here. We do not see particularly strong divergence on the daytime frame going into the low. There is some present on the RSI. Okay, so if we go from here to here, we get flat to slightly higher lows, whereas we get lower lows. So there is bullish divergence on the daytime frame going into this low. Okay, it's not amazing, it's not mind-blowing, but it's there. Alright, and we've got very long-term bullish divergence in the MACD. If we bring up the OBV for a minute and observe the move from the low here to the lows more recently, we can see that we have from the close to the close, we've got bullish divergence on the OBV, positive accumulative volume over time, bullish, becoming bullish. So that's another positive sign that we may have turned the corner here. Now if we look in the weekly time frame, we can see that we have done what I like to call a round trip. You know, in the RSI we've gone from the low into overbought all the way down into oversold on the weekly time frame. Okay, so when we bottom in oversold conditions on the weekly time frame, we're talking about the likely completion or more likely completion of a very significant correction. So that is essentially the classical analysis. So now let's bring up the count and let's bring up what I've got as a correction. I'm not 100% happy with it because it is very difficult to read this one. Now we move up into the high, like I said, 1, 2, 3, 4, 5, clear as a bell. We get a sideways triangle in the 4, we get a double zigzag in the 2. 1, 2, 3, 4, 5, nice alternation between corrections. Now from there we get what I'm going to break it down into line to try and make it a little more observable. We get what I think is a zigzag into a W, X wave, zigzag into a Y, X wave, and then we get a zigzag again into the Z, and it finishes with an ending contracting diagonal. Now you might not believe that the 3 is shorter than the 1. When we're measuring a diagonal, or when we're measuring any wave for that matter, which has to abide by certain legal presets with an Elliott wave, it must be legal in linear because that's the actual length of the wave. Okay, 60% of something is 60% of something, 50% of something is 50% of something. A log chart skews that. If we are going to live in a world where we get to pick which chart we believe, we're going to end up with conflicting counts. If we live in a world where it must make sense in linear, then we're all going to be in agreement, and that's why. Well, that's why that's the way we do it. The only way we can observe a chart to make sense of it is in log. But when we're measuring something for its legal, does it follow the Elliott wave rules? We should be measuring it in linear. And what we can see quite clearly here, if we measure it, let's just get our little candlestick chart up again, and get our fib extension tool. We take the length of the 1, project it from the 2, and we've got a 3 that's shorter. Okay, I think it's actually there, excuse me. So high to low, from the 2, we get the 3 comes in before the 100% extension, so it's shorter than the 1. The 4 overlaps the 1, a prerequisite in Elliott wave principle for a diagonal. There has been, from when the book was written, an example of that not being the case, but I don't think that's permissive. I don't think that means we can always, whenever it's convenient, ignore its requirements. I think we should look for the best possible structure. We get 1, 2, 3, 4, 5 as an impulse into A, 3 into B, and an impulse into C. We get another zigzag into 3. We get a zigzag into 4. We get a zigzag into 5. 5 is shorter than 3. 4 is shallower than 2. 3 is longer than 1. 3 is shorter than 1, excuse me. We've got a contracting ending diagonal. We have a little throw under at the bottom, which is very typical, just like a throw over in a contracting diagonal and a bullish diagonal. And then we have a break of the structure, okay, in an impulsive move supported by volume from below. That looks like something's bottomed. Now, it could be a continuation of the correction. That's always possible as well. Just because this is completed in a diagonal does not mean that we can't have some kind of corrective move and then another impulse lower. Okay, because this could have been a separate zigzag with a C wave diagonal. We could then have another X wave if I've miscalculated this and the X's and the Y's are in the wrong place, or maybe it's an impulse to a low, then we've got an A, then we've got a B. I don't know. I'm just saying, if it's done and this is the final move down as a contracting ending diagonal, then it's likely done here. Okay, how much confidence I have in that? Not much yet. I want to see everything I spoke about broken and proven first, and then I will have more confidence that we've bottomed. But 92 point whatever percent it was, that's sufficient sell off for a wave 2. Okay, so from there we could talk about wave 3 targets. Now the problem with this is we're in an exponential growth marketplace, where a move within our first wave was 18,235.07%. We expect wave 3 to be significantly bigger than wave 1. Significantly bigger than wave 1. Traditional targets in linear scale are 1.618%, 2.618, and 3.618. After that, we go into extreme extensions within the 3, which are still possible but less likely. The most common is the 1618 extension. Now, 1618 in linear presents us with a bit of a problem, because when we bring up our wave 3 targets in linear, we see that the 1.618, and this is adjusted to linear, not to log scale, brings us to just clear of the prior highs, essentially, in terms of how it would physically look on the chart. This leaves absolutely no room, in my mind, for the wave 4 to correct within without overlapping the 1, thus voiding the legality of it being an impulse. Can't happen. So I see that as a highly unlikely target, and I think these are extremely provisional, purely because I have no evidence at all, and very, very, no good examples that Elliott wave that Fibonacci extensions even work in exponential growth markets at log scale or linear scale. So the most conservative estimate we could make, which would leave enough room as a linear extension to actually get a wave 4, would be in the 2618 to 426 target, 4236 target, somewhere between $8 and 13.6. However, as linear targets, I think they are extremely conservative and wouldn't really look right as a wave 3. I will leave you, if you've got access to a chart, to comprehend and to fiddle around with the idea of logarithmic extensions in Fibonacci extensions for a wave 3. I'm not going to entertain them because I'm not sure any of this is valid, if I'm being absolutely honest with you. I feel that the wave 3 could be so much bigger than the wave 1, and actually look correct when adjusted on the chart, that I didn't really want to discuss possible targets because I think I'd get laughed at. So we'll leave it there and just say higher highs once this thing bottoms, whether it's now, whether it's in another year, could easily be. Who knows? We saw the time fib going out quite a long way. It could go out much further. When it bottoms, we're going to new highs. If I'm wrong, I'm wrong. But after such a strong start, 5 waves up and a big long corrective move back, when we do bottom, I believe very firmly that we're going higher, and that may have started already. So there you go, guys. Thank you very much for joining me on this technical analysis of Cardano AUD. I hope you've enjoyed it. If you're new to the channel and you like what you've seen, please subscribe, smash the like, hit the little bell notification icon to remain informed of future video releases. Feel free to leave us a comment in the comment section below. And as always, an enormous thank you to my Patreon subscribers. Your support is greatly appreciated. If you're interested in joining the Patreon, there's a link in the description box below. Head over, have a read of the tiers, and feel free to sign up whenever you like and access all of that educational goodness and learning about Elliott Wave, plus a whole bunch and raft of other benefits. Alright guys, thank you very much for joining me, and I'll be back with you as soon as I can. All the best. Bye bye.